Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Hello, everyone, and welcome back to another episode of Living Your Greatness. This is your host, Ben Mummy, and today we have a new guest, and his name is Patrick Karim. For those of you that don't know Patrick has been a proprietary capital manager and chart trader since 2006. With a background in commerce and psychology, Patrick has an ongoing career in systems engineering. Patrick's analytic mind helps him excel at achieving a methodical approach to evaluating trading scenarios. The psychology background helps Patrick understand the human factor. For example, overcoming stress, which is mostly responsible for maintaining a successful career. Pat, welcome to the show. It is great to have you on.
Great intro, Ben. Thank you very much for inviting me, man. It's my pleasure.
No problem, Pat. All right, Pat, so let's kick it off. Could you start by telling us more about your background? Where are you from, your formative years, and how you ended up in this profession?
Yeah. Okay. So I was born in a small town in Quebec called Sorel. For anybody who's from Canada or Quebec, they'll know it's a small French speaking city. And after that, we just my parents, they thought I'd be better off like learning English and French, so they sent me to there was a small primary school. And after that, I went to English school, which was the closest one. The high school was in McMasterville, so South Shore of Montreal. But that opened my eyes. So a lot of people like from the small towns, they stay in their small towns all their life. And just that click, that expansion, when the first time I saw those high rises, and I said, wow, there's like something else out there, you know. And this was like in the 80s, right? Like I'm 45 right now. I was born in 76. So we didn't have internet. We didn't know, like it was a shock. And I don't know, that kind of clicked something in me about I was kind of like a nomad, you know. I always liked learning new things, seeing new things, understanding new things. Sometimes it's an advantage, sometimes it's a curse. After that, I did stints in Europe. As soon as I had opportunity to go work in France in Paris for a few years, came back, then went back to France, worked in the French Riviera a few years, and then back, then went to Dijon to work a year or two. And all that, I think is like, it's like accumulating into like the charting world, why I love it so much. All this all these different takes, all the way of looking at a chart, hitting it with different angles. And it's just like, I think my personality, whenever I do a chart, is like represented through the charts. It's always try to look at it a different way, you know, never judge a culture, you know. Sometimes the French, they're like this and that, but once you go live there and you're in their shoes, you understand the culture, and then things start making sense, right? So I kind of think I'm trying to I have that approach when I do charting, right? And it's like anything in life, Ben. It's the way we do something, we analyze something, it's based on all our past experiences, right? And it's a mixture of that. So it just gives that crazy result there, the charts you see, and they're continually like evolving, right? As I learn, as I discover new things. And then some premises I used to have, then, oh, Pat, that that wasn't quite right. You know, you adapt, you roll the punches. So that's pretty much how I'm doing charting today. Other than that, like I'm a full-time consultant in IT. I'm an AIX Linux engineer for people who know that. And that's the thing that probably offsets also my charting, is like just my analytical, you know, binary type of thought process. So I'm super emotional, but I do have skills in like identifying, am I in a bullish trend, bearish trend? Am I above a 1-year moving average, below it? So that helps me. My IT background probably helps me a little bit throw that type of ingredient there in my chart analysis. That's a pretty much a recap there of my situation there. And when you see the charts today there, hopefully that explains a little bit of it.
That's awesome, Pat. Thanks for sharing us a bit of your background. So, Pat, it's clear from some of the interviews you have done on precious metals that you have a very strong grasp of the technical charts in this space and other markets. For the benefit of my listeners, could you take a few minutes to help us better appreciate the stock charts? For example, what is it meant by a support resistance levels of 50-day and 200-day moving averages, as well as price and momentum indicators? Are there any other technicalities we should be paying more attention to?
Yeah, for technical analysis, they're like at the beginning, it's super overwhelming when you're new to it. You click on all the indicators available in your charting platform. But over the years, you start noticing patterns or fractals or recurring movements in price. Then you say, man, it's like this is like based on something bigger than just that valuation of that company. There's like human emotions, greed cycles happening to that. And that's where you resistance and support. The best correlation I could do analogy is how it's created is people buy a certain price. If the price action goes down below that price, imagine it's you put 100,000, you didn't tell your wife, the price action goes down. As soon as that price goes back up, man, you were afraid to tell you couldn't sleep for nights. You were afraid to tell your wife you lost all your savings. As soon as it comes back to break even, you sell. Oh man, I could breathe, I got away with murder, and like we do it. So charting is pretty much that analogy. And it's the inverse also at the when you go up and higher and then you start getting greedy. You The people who bought early, them after they did double, triple their profits, their money, they start taking profits, it starts creating resistance. And if you bought on fear of missing out, then you're buying at the top because by the time the price goes up for it to be mainstream news, the price has to go really up, like Bitcoin after it went up 5, 6, 1,000%, then like CNBC starts talking about it. You're in fear of missing out. You don't know anything about the charts. The only thing you know is about CNBC telling you that this is the next thing since butter, the best thing. You buy on top, but what you didn't know is the people who bought early, they're starting to sell because not because they don't like you, and it's just because they've hit their quota, their price targets. Price action goes down, and then you're trapped. And then if that starts cascading going downwards, then every time there's a rally going up, that's like when you're below an important moving average or 1 year moving average, those rallies, they get sold into. So they call them bear market rallies, right? And once that cycle goes all the way down, you capitulate. You say, okay, I'm a man, I lost all my money. There's a divorce coming. You sell. There's pretty much everybody else is the same thing. Everybody will have sold, and then the price could go back up. Now there's no more overhead resistance. Because all those guys that got trapped, they close their positions, and then the price action goes back up. And what do? You're burned by the stock. You don't want to hear about it until CNBC talks about it, and then you rebuy at the top, and then the whole thing starts over. That's why humans were the worst at trading, because there's traps everywhere. Trading's made to get your attention at the wrong moments, while you should be entering the room. I think this is a Eric Sprott saying, you want to be lonely in the room when getting a stock. Then you have a chance. You have the edge. You're the early bird. And when nobody's talking about it, when you're close to a 1 year moving average, where you're just below important resistance, but it has been flatlining, and you're right there. Then as soon as you close above, then you could put full throttle, and you know that you have the odds on your chances on your side.
Absolutely. Thanks for explaining that to us, Pat. So, Pat, this leads me to my next question. Part of your background is in psychology. Does this give you a competitive edge at performing technical analysis? Are you able to better understand investors' sentiment with respect to making investment decisions?
Well, I always had an affinity to the psychology and like human behaviors. So I did a couple of years at Concordia University in psychology. After like I dropped out, I broke my arm wrestling, and then I missed a whole bunch of exams. Then I saw like a school there in IT. Oh, look, I'm gonna go. I like IT. Computers were just starting in '96 or '97, and but I always kept that. What I've learned though, like about human emotions, just like I explained the analogy, like understanding how the emotions react helps you like you could look in the mirror and say, oh man, that's what's happening to me now. I'm in fear of missing out, or I'm in fear, like, oh, I'm not gonna buy the stock. It just went down 50%. But if you would have looked at the chart, you would have seen that it had already broken out and it's correcting 50% to the breakout line. And that would probably be the best low risk, highest reward entry you could have had in your life. But your emotion profile in our DNA makes it impossible almost to buy at those entries, because if you didn't have access to charts, you say, why it went down 50%, man. I'm not touching that thing. But actually that would have been probably the best low risk entry. So all that psychology, trading, Ben, it is just psychology. It is just that. Once you understand that, then it's a lot easier. At least if you're not able to control your own emotions, at least you understand that that's what's happening. So it gives you at least a fighting edge there that you could take some good sound decisions there, contrary to your own feelings.
Absolutely. So, Pat, what macro indicators do you pay attention to in addition to technicals when you analyze the markets?
Well, I'm only going to take macro into account, something that I could chart. So saying, the macro is like just words, like, I don't know, they're printing more money or something like that. If I can't chart that and can't see a breakout, or I can't identify cycles and I can't situate myself, are we starting a cycle where they're going to be printing more? Has there been an explosion in the money supply? Has that been discounted into the prices of assets? So if I can't have a chart, and if I can't have long-term chart, I stay away from that. So no matter what the narrative is, Basel or something, anything that could be coming up, comics that's going to blow up. If I can't see actual numbers and repeatable patterns, for me, that's purely just noise, because I have to take that and then figure out if there's correlations or there's lagging effects with the actual price of the instrument I want to trade. So I try to totally discount that stuff, Ben, and not even to consider macros unless I could chart them. And the ones I can chart is like money supply, inflation rate, GDP, deficit and surplus. Those are huge, important macros. The US dollar, currency pairs. Those are the type of macros that I look at there. But other than that, yeah, if I can't chart it, it's uh, it's not even on my radar.
That makes a lot of sense. So, Pat, what credence do you give Basel III? Could you explain how the bullion banks would be affected and how this could affect the physical market of precious metals? Alasdair Macleod from GoldMoney says this will be disruptive for the precious metals paper markets.
Man, this Basel III thing, it's I keep a tab on it. I read the Alistair stuff, and I read other guys who said this is going to be bad for gold. Some say it's good for gold. And man, that's another reason why I stick to the charts, because I just put a poll out recently on Twitter. I said, Basel III, like, is it going to be a sell the news type event? Is it something that the market already knows, already discounted, and when the news actually comes out, that's a top? Or is it nothing's been discounted and the actual enactment of it is actually a game changer and it proves that something else is going to happen? Or it's a non-event? So all those three scenarios are possible. And honestly, there's too many opinions. I'd rather let all these guys with opinions consult their hedge fund billionaire friends or whoever they're working for, let them put their bets. And I'm going to see the residual effect of all these people putting all their money at the same time. I'll see in the price action of the chart. And that's my only fighting chance of surviving this, trying to decide if this is good or bad. I don't even know, like, the details of Basel, exactly what it means. Like, I've read the headlines, but I know enough not to use it in my analysis.
So, Pat, yesterday we saw a significant change in the gold and silver precious metals and minor prices. In fact, the other equity markets were down too. What would explain this price action, and what does a move of the nature tell us about the price action for the rest of the month?
The way it works, like in multi time frame analysis, you have let's say the hour candles, the daily candles, the weekly, the monthly. And I know the higher trend on the weekly, monthly, quarterly, and up and higher. We're starting to turn the corner. It's going to be we're in a bull trend. When I see a daily move like that, it's a testing. It could be back testing resistance on the smaller time frames. It's just like normal gyration on those smaller time frames, because all these daily closes up or down. Let's say we have a 4% close day, but at the end of the month, that's just going to be noise in a bigger candle, right? We won't even practically see this price movement in the whole range of price action during the month. So those signals on the smaller time frames are much less important than on the bigger ones. They can, however, if there's a change in shift, so let's say you get one bearish day, two bearish days, three bearish days, and then it adds up to a week, then the week becomes bearish. If those cascade, like upon the ripples in the pond, which like they amplify, then you could have a reversal on the higher time frame. But until that happens, man, this is like way too close to the steering wheel. understanding other than for technical reasons why it did a back test. For me, it has practically no bearing. And every day, like on CNBC, oh, the price moved because, and gold lost 4% because of so and so said whatever, or this news report about the PMI or something. Man, the macro tidal waves are much stronger than any one of these single events together. Maybe over time, all these single events could build up to something, but on one day, I don't put much emphasis on that at all.
Absolutely. Thanks, Pat. So, Pat, what can you tell us about the relationship of the US dollar market to the gold and silver markets in the short term?
Anything denominated in a currency. So if the US dollar is depreciating, if mine, like gold, let's say gold is just a rock, and the US dollar goes down, that means you're going to need more US dollars for to buy that gold if nothing else changes. So that's what impact you could see when you value something into a fiat currency like the US dollar. The gold has performed well with a combination of macro drivers. US dollar going down helps gold, but gold could also go up with the US dollar if, let's say, real rates at that moment are tanking, or if real rates are going up. Gold can also has shown periods where it went really up with real rates, but at that same moment the US dollar was tanking. So it's hard. Everybody's trying to figure out the one correlation for gold, why it's going a certain direction. But most of its bull runs were in the periods where the US dollar was going downwards. It could go, US dollar could go sideways, but there could be other drivers. It could even be the market's so sneaky that it could even be discounting the current US dollar strength that as temporary, gold not believing. There's always this type of wording like we could use to try to, to justify, oh, why isn't it following US dollars going up, gold's going up? It could be discounting that rally is a fake rally in the US dollar. The macros for the US dollar are still bearish, that eventually the US dollar will resume its downtrend. And that's what gold was pricing in while it was going up. So it's there's no direct correlation, but there is some good periods of correlation where gold really does nice there when the US dollar tanks.
Thanks for clarifying this, Pat, because I know there's usually some confusion for general investors. So, Pat, this leads me to my next question. You have referred to the relationship between the money supply and the price of silver. What is the M2 money supply, and how will its growth potentially affect the silver price in the near future? Can we actually learn from past historical correlations?
Look, the money to supply, sometimes I was using the M1. Some people say, oh, Pat, you have to use M2. So I'm not 100% sure on the definition of what's encompassed into these M1, M2. I think there's even M3 money supplies. But as a chartist, I did notice, so I could plot the M2 versus silver price, and then you see there's some correlation, but not that much. But the true correlation is the rate of change. And that's like I call it the Rosetta Stone of what drives silver, gold prices up. It's a rapid rate of change in the M2 money supply. So whenever there was a money supply, it's like if you look on the linear or log chart, the money supply just going up slowly, slowly, slowly. But sometimes there's volatility within that M2. So let's say they printed so much money here in March or in 2008 after the crash, they print so much money. Then you see that rate of change, at the speed at which it increases, and that spike has a lagging effect with the price of silver and gold. So from every time we've had a spike, a little time after, silver and gold always exploded. The US dollar priced in maybe that excess M2, depreciated the money supply, deficits went up. So that's what I look for. If you look at the M2, not just look at the nominal, because the nominal is so much higher, then it's always going to go up and up and up. But your edge is to see when is there shocks into the M2 money supply. And that's when you could look at individual charts, position yourself close to a breakout, and you know that will eventually have some effect on the silver or gold prices. And that's your edge to once the market really starts discounting the increase in CPI, the increase in inflation of all because of that insane money supply, eventually it comes back and catch it there 3, 6, 9 months later there.
Okay, great. So Pat, can you tell us about the price action in the short term for gold and silver? Is this going to happen in Q3, Q4 of this year? Is it going to make its next move?
Man, I say it often there, like at any moment. But since like I'm dealing with monthly candles or sometimes quarterly candles, for me, any moment is like it could be in the next candle we could have that breakout. So we could have smaller time frame volatility, close to a breakout line. But all the charts from what I've seen, the way gold exploded back last year, silver has pretty much the same type of chart pattern as gold did, but lagging pretty much like 1 year lag with gold. And it could be, yeah, I had lofty targets for this quarter for silver and the gold for Q3, but that could always scale a little bit in the future there. So the outlook is bullish, and we're much closer to a breakout than a breakdown at this stage. And yeah, definitely 2021. It's still very possible there to have let's say $50 silver and gold going back above its all-time highs, 21, 22, 2300. The charge constructs are present. We just have to wait for them to confirm, and when the market's ready for them to explode, it's going to happen.
Okay, great. So, Pat, this actually leads me to my next question, which is, could you share with us your understanding of the breakout line for the price of silver and gold? Will the precious metals soar after reaching these points, and how far will it go?
Well, right now the line in the sand for silver on the monthly close, $29 a month, a solid monthly close above like $29 for silver. And it's technically there's like practically a vacuum that should have it uh, warp all the way above 40, and usually fear of missing out and all that insanity. Once we start hitting $30, $40, everybody can start talking about it. It's a program in silver's DNA to go like parabolic. So it's probably going to hit its all-time highs once we're above 30. uh, it's going to make a run for its all-time highs there and really trap a lot of people buying it close to 50. And for gold, yeah, the line in the sand right now, I believe it's at 1950. So on the monthly or quarterly chart, there's important resistance that's defined there. If it's able to get above 1950, overriding its all-time highs is pretty much programmed in, and it should overshoot. Like everything happens with human emotions. You get to a certain place, people pile on, you overshoot, and then because you got in early, you're going to take your profits. And but people buying at the breakout or close to those all-time highs, they might get trapped because they're going to be expecting bigger gains than what for that swing move up there they might not get.
That makes a lot of sense. So, Pat, if we do have a market adjustment or crash in the next year, how would this affect the price of the gold and silver metals and miners? What are some of the worst case scenarios?
Timber. Well, it like I know there's some guys like some people think the gold and silver are so depreciated versus U.S. equities that it's not gonna do much. But if we have a liquidity type crunch like in 2008 and even March, we've seen like when there's a sell-off, US dollar spikes, the VIX volatility index spikes, the gold silver ratio spikes, everybody's going back in gold versus silver. So of course they're gonna take a hit. The juniors it's gonna be blood in the streets. So the only way if you're long term, you're invested, and you don't want the hassle of trying to time, because there's techniques like there's cycle analysis to try to get you close to that. But if you don't want to play around with that, don't be leveraged. Don't be leveraged. We're early in the bull cycle of precious metals versus equities. We're at all-time lows. Like over, I have a 130-year chart of the Dow versus versus gold, and the U.S. equities have never been as high valued versus precious metals. So you're entering low risk. Um, so yeah, make sure you're not leveraged, and the subsequent rebound out of whatever crash, whatever insanity of money stimulus they're going to do, precious metals they have they're just going to rocket as they depreciate nominally their US dollar. So yeah, there could be a lot of downside there, but it depends where it happens. So if you're scared, when is the crash going to happen? Is silver going to be at 50 and then we crash 50%, go to 25? That's practically where we are now. It all depends where we get that 50% crash. And if silver's at 70, then we get a crash in 2023 and silver's at 70, then we'll still be higher than today. So you can't live in fear. Now you're closer to a breakout than breakdown. And yeah, just don't be leveraged, guys, please.
So, Pat, moving into a different direction, on Twitter, it is clear to your followers that you highly respect the gold ventures. Why do you admire his portfolio called the Silver Sidfolio? what gives you the conviction that this portfolio will continue to perform well in 2021?
So much pressure on GV. GV, man, you gotta hope your picks are good, man. It's well, I always at the beginning I started looking at I did podcasts on the Eric Sprotts. So somebody got me the list of wherever Eric Sprott had money, and I reviewed all of that. So I have a podcast on that. Then I did also for Don Durrett. He had a whole bunch of his top 25 picks. I did a few podcasts on that. And the GV, I did all his portfolio. I know it evolved over times. He dumped some of them. He added some. But I just want to see, because I don't do due diligence at all. I could be charting something that's total scrap. I don't even know, you know. So I said, let's see if I could take somebody who did some due diligence, that I don't know. They looked at whatever metrics they want, like sample size or like all these buzzwords for the miners. And when I did the charts, he saw the potential in whatever, like they had reserves on the ground and all that. And I just said, okay, let's see what the charts are telling me, what the market participants are thinking. And man, the charts, they look great. So there's some maybe that are overextended, but a lot of them that were just doing bullish crosses of 1 year and 3 year moving average. And there's a whole bunch of them, man, of that list there. I did like 3 installments. Like I did one last year, one in January, one in recently. I like see how they evolved, and most of them have been doing perfectly. Either they break out, then they consolidate back above an important breakout line, and then they're back off to the races, all at different moments, you know. So yeah, so GV was kind of an experiment there, just like giving me inspiration of what to choose, you know. Instead of just choosing random stocks, I said I'm going to choose stocks that are vetted by somebody and see where the dust lands.
So this moves me to my next question. For the benefit of millennials like myself who are listening to this podcast, what allocation advice would you give us for investing in precious metals? As for silver, how would you recommend we structure our portfolio? So allocate our money across the physical metal and silver miners.
Everything on the most riskiest junior miner you could find. I'm kidding, guys. I can't say that. Well, I'm just making a joke because I don't think I could really like, everybody has their own profile. Everybody has their own allocation, because at the end of the day, you have to own your decision. Because what happens is, if I, like in my beginning, I used to go on penny stock forums and this guy says, oh, this is going to the moon. But then let's say the price corrects 30%. That guy, I can't find him anymore. He's not on a penny forum anymore. It was a pump and dump. And I had, the lesson I had is I have to account myself. I have to instrument myself with the knowledge to understand where my weighing should be. Where's the gold to silver ratio? Where are my odds? Where are the rewards skewed in my favor? So for the allocation, everybody has to decide according to their profile how they want to structure it. So the only like value I have that I could bring is some type of evidence on probabilities of a certain chart going in a certain direction. And then folks, they take that and they take that tiny part that I give and they encompass it in their emotional profile, their trading framework, their portfolio, their tax situation, all that stuff, which I have no idea what's happening. And then they could use my value to fine tune something that's much bigger. So I can't really give any guidelines like that. I could just give my opinion on charts where I think the skewed rewards are in our favor or not there.
Okay, great. So, Pat, could you share with us your philosophy at investing between mining producers, mid tiers, and junior miners in the silver space?
Well, yeah, if I circle back, I have no distinction between any of those type of asset class. But I did notice that most of the small penny stocks have explosive moves at the bottom, right? So some fundamentals, you could say, look, Pat, it's normal. A $1 billion company to double in price, they have to have like they have to go to be a $2 billion company, while a penny stock, which is at a 10 million, I don't know, just one news release and the inflow of money leaving U.S. equities in the mining sector is just going to make that thing blow up, right? Because you're going to be there when nobody wants it and everybody wants to go in that tiny door, and then it goes from 10 million to 100 million, which is maybe still not valued appropriately, and then you'll get like 10x. So that's pretty much like my observations. Those small nano caps have a tendency to be like little firecrackers. And are they less reliable? I'm not sure if the chart's bullish and it gives me a risk to reward or a measure move that's a 10x or 5x. I go along with that.
This brings me to my next question. What are your personal top stock pick recommendations for 2021 based off the charts?
Well, the chart firecrackers I had there, I had this thing I used to call them my rocket ship awards. There, I put a little rocket on there. I shouldn't do that because that's like emotion stuff there. You should keep that away from your trading. There's a few, I'd have to recheck them there, but anybody could go on my Twitter or on my website there, North Star Bat Charts, they could find them. I think Sable was one of them, if I could name one, that had a good breakout. So I don't know where it is now, because the thing is, the more the price moves, it gets my attention, right? And then I mention it. But you should take that as a contrarian also, that, Patrick, you're mentioning it because the price going up. Is it too extended? Is it about to have a pullback? Those are questions you should ask, before jumping on something. It's yeah, that's, I don't know why I spot that name. I think it's because a review I did recently, but there's a whole bunch in. I'd recommend anybody just to look at my GV Portfolio podcast, the latest one. Plot them on the graph and see the ones that are closest above and closest to their 1 year and 3 year moving averages. And those are probably the best entries you could get for stock. And especially if you're scared and you're hearing bearish news about that company, it's probably even a better reason to buy it. Like AAG, yeah, this one's coming back to mind. It's severely corrected aftermath. And I don't know, I was watching Twitter and people, Peru or whatever, the chart was suffering, but technically it was just building a bullish flag. And when you understand technical analysis, you say, okay, it's bullish flag above an inclining, still 3 year moving average. It was retesting an important breakout line, which I call a wall, previous resistance, turn support. I said, man, if this holds, this is probably the lowest risk entry you'll ever get in aftermath silver. And I think I was like at 48 cents or 44. And what happened after that? It just came climbing up. I think it's up 50% since it hit those lows when everybody was scared and it was the end of the world. Man, reading headline news, man, it's not good because it whipsaws your brain. You're all over the place. You jump ship from one to the other. Yeah, so I don't know, those two came to mind, but I don't want to disrespect any of these other companies. There's a ton I reviewed that have insane potential. So go check my videos, guys, on YouTube, GV Sitfolio podcast there.
I will make sure to put in the podcast notes, where people could go find you. So your YouTube channel, your Twitter. You also mentioned your podcast, so I'll make sure to put that too. But Pat, I just kind of want to end off today by really thanking you for your time, for being here. You've been very generous. So thanks for being here, Pat. And I hope to have you again on the show in the near future.
Wow. Ben, since I know you're from Quebec there, anytime you want there, I give privilege to my fellow Quebecers who got to represent, man. Thank you, sir.
This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos. Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review.